Well, we are counting down to the budget, and today was the day of the economic survey. Moderate growth revival, short-term fiscal slippage, stabilizing GST transition, and miles to go for gender equality. The economic survey for FY18 has been tabled in Parliament. The two volumes, running into more than 300 pages, is a lot slimmer than the last year's survey. But here are a look at the key highlights. Let's start with growth. Growth is on the revival path, but the pace will be moderate. GDP for this year, that's FY18, is pegged at 6.75%, slightly higher than the chief statistician's estimate of 6.5% for the next year. And that's more important. The survey expects GDP in the range of 7 to 7.5%. Now, the survey wastes no time in pointing out that rising crude oil prices remain a key risk to growth. It highlights the upcoming listing of Saudi Aramco, and that's the big one, and predicts that output cuts will be aggressive to ensure a good valuation for the oil giant. So watch out for oil prices. The survey is also hinting at a minor fiscal slippage. It says, and I quote, "A pause in general consolidation cannot be ruled out." However, it does expect states to meet their fiscal deficit goals this year, and that is thanks to the GST. Now, since the introduction of the GST, revenue growth in the share of taxes of states has risen by a whopping 25.2%. Compare this with a 12.6% gain for the central government and the 16.5% gain in overall taxes. So good news there coming in for states. The survey has also showed that GST has led to a 50% jump in the number of indirect taxpayers, and goes on to pitch for the revenue neutral rate to be kept between 15 to 16%, while revisiting the idea of a single rate of tax. That is unlikely over the next few years at least. But for the large street, the survey is laced with euphoria and caution. It points out that a large number of savers are starting to put their money into equities, but also warns that there is a threat of a correction. It's not just the threat of a correction in India, but globally as well. Investors and market watchers are pointing out to the possibility of a correction. The survey also lists out a 4-point agenda for the next year. It talks about stabilizing the GST regime, tackling or continuing to tackle the twin balance sheet issues, privatizing Air India, staving off macroeconomic threats. The survey says the twin engines of growth that propelled the Indian economy in the 2000s, that's exports and investments, continue to run below the takeoff speed. It also points to the deceleration in rural wages. And finally, the cover of the economic survey was pink and even had the hashtag #MeToo in the first page of a chapter highlighting gender disparity in India. It laid bare the ugly truth that parents in India continue to have children till they have the desired number of sons. The survey goes on to say, and I quote, "Indian society has miles to go before it can sleep in good conscience," end of quote. Here is the architect of the economic survey, the chief economic advisor, Arun Subramanian.
We project nominal GDP growth this year for about 10.5%. Stock prices are at record levels, which means that there's expectations of, dynamism going forward. The number of GST taxpayers has increased by about 50%. We need to stabilize GST because export refunds, compliance, revenue will still have to be, achieve an equilibrium. Going forward next year, because of all these factors, we think that growth will rise to between 7 and 7.5. This year, oil prices went up. That affected consumption and the government finances, and that also held back real economic activity. We know that the sex ratio in India is highly skewed. If it's the last child, skewed towards males. If it's not the last child, more female.
Well, that's the Chief Economic Advisor, Arvind Subramanian. Joining us now on the show, a panel of eminent experts: Leo Puri of UTI Asset Management, Jahangir Aziz of JP Morgan, William Foster of Moody's, Naina Kidwai of Max Financial Services, Geoff Lewis of Manulife Asset Management, Arun Kumar, Chairman of KPMG, Rashesh, Shah of FICCI, Shobana, Kamineni, the President of CII, and of course our very own Lata Venkatesh, also with me in our Mumbai studio. Ladies and gentlemen, appreciate you joining us here on the show. William Foster, let me start start by asking you, because one of the highlights of this economic survey is what it talks about in terms of the fiscal consolidation roadmap. And let me quote to you what the survey says. Fiscal policies should ideally have targeted reasonable consolidation, given the fact that we're expecting growth to move up. However, setting overly ambitious targets for consolidation in a pre-election year based on an optimistic forecast that carries a high risk of not being realized will not garner credibility either. How do you read what the survey tells you in terms of the fiscal consolidation roadmap, William?
Well, we've been expecting a slight slippage this year, given the fact that GST and demonetization were disruptive to the economy. Obviously, collections around GST and integrating smaller firms and exporters into the overall changes in the supply chain and the reporting has been a bit more difficult than the government would have liked. As a result, we've expected some slippage in terms of tax collections, resulting in what we expect to be more of a deficit around 3.5% of GDP at the central government level and 6.5% for the combined level. That sounds somewhat consistent to what we're hearing. Moving forward, I think what's most important is that based on this year being sort of an exception because of the disruption with reforms, particularly on the revenue side, that the government remains committed in the future to fiscal consolidation and a roadmap that's feasible, credible, and over time will bring down that large debt burden, which is a key weakness in India's credit profile. But we believe that that is indeed what the government maintains their commitment to. The composition of spending will be very important too, because that will help with that overall objective and optimize the expenditure. But on the revenue side, I think another thing that the survey obviously focused on was the fact that there is clear formalization of the economy going on, which moving forward bodes well for revenues.
Yeah. Well, yes, they do talk about the formalization of the economy, but if you're factoring in 3.5% as the fiscal deficit target for this year, what about next year, William? What's the target now in light of what we've seen and heard for FY19?
Well, we need to see, what the finance minister says in the budget speech, obviously. But the expectation is that we'll, continue to maintain a path of fiscal consolidation. The exact numbers, obviously, we don't know right now. But over time, it should be a steady downward trend.
Okay. Well, I'll just take this fiscal deficit argument forward, Shireen. There are two things which the CEA points out, which is new data for us. In the last 12 months, the contribution of personal income tax to the kitty has risen from 2% normally before DEMO and GST to 2.3%. And doing some econometric analysis, the CEA arrives that this might, in course of time in a year or so, entail 65,000 crores more by way of income tax. Now, that's a very decent number, and that's the first positive thing we have heard in terms of the impact of DEMO and GST formalizing the economy. The second thing he says also is that states, as you pointed out, are more comfortably off. And if they were borrowing more from the market, it was only because borrowing from the NSSF, the small savings fund, is more expensive. And that's why they came to the market. So the bond market is reading it wrong. Actually, states are, comfortably off. Now, Mr. Leo Puri, putting these two together, that if indeed personal income tax is ticking higher and states are better off, there is even less excuse for not doing fiscal consolidation, isn't it? What would your response be if, in spite of this, fiscal deficit was pegged at 3.2 or even higher for next year?
Yeah, I would say unequivocally that it would be a really bad idea to go down the path of starting to justify fiscal slippage. I think it's all right to perhaps argue that maybe we missed a month of revenue collections because of GST implementation, but we are highly committed and demonstrate that in the budget. But I think it would be extremely complacent, if not dangerous, to go down the path of saying we're now going to favor growth over fiscal probity. I don't think India is in a position to do that. I think we'd be throwing away several years of hard-earned credibility if we do that. And I think as global markets weaken, as they inevitably will over the course of the year, we will be severely punished if we actually let go of that credibility. Okay, actually, you manage a lot of, your fund managers manage a lot of debt funds as well. And they must have been ravaged by the manner in which the yield curve has steepened.
do you think that, if we let go of our macros, we may even endanger the flows, both FII and domestic, into funds?
Well, fortunately, our managers had anticipated in a somewhat contrarian way a hardening of rates. They have not been riding the curve downwards at all. So they were not surprised, but clearly there would be a high degree of disappointment in financial markets amongst institutions both in India and globally, were we to at all signal that we are taking a more relaxed view towards fiscal consolidation. We've heard many voices arguing that somehow that might be acceptable given the stage of development in India, given the need for stimulating growth. But pump priming at this point cannot be a substitution for retaining this very hard-earned credibility in an environment that carries tremendous risks, which the CA himself was underlining. And I think we should certainly not ignore his strong reference to the risks that he's highlighted.
Shri?
We'll get to the risks in just a minute, but just to finish the point on fiscal consolidation, I'll end by quoting the survey again. And this is what the Chief Economic Advisor says: reflecting largely fiscal developments at the centre, a pause in general government fiscal consolidation relative to 2016-17 cannot be ruled out. So what will the budget do is the question now, and we'll get answers to that on the first. But let me address the issue of growth. And then Kidwai, if I can come to you. There is a pickup in growth that the survey factors in to between 7 and 7.5% in 18-19. But it also goes on to talk about how the twin engines that propel the economy in the mid-2000s, whether it's exports or investments, they continue to run below the takeoff speed. In fact, the survey goes on to say that corporates have not raised commensurate amounts of capital, suggesting that their investment plans remain moderate. Private investments, while seem poised to rebound, will depend on resolution as well as recapitalization. So where does that leave, A, the growth picture as well as the private capex picture?
Well, Shireen, if you look at the forecast, 7 to 7.5, that's quite a wide band, and clearly not a robust enough growth for a country like ours. So it's cautious, and it's cautious exactly because of the reasons you mentioned. Export numbers not measuring up, investments, while green shoots are beginning to emerge, it's very slow and needing a lot of nurturing. So the fact is that, yes, the trend is positive, but it's not a robust positive as India might have expected, given the success of the GST, because we all hoped that GST would lead to at least a 1.5–2% growth going forward. And clearly that's slower, both because of the operational issues and also because of the way the rate structure is coming through. So it's realistic. I don't think 7 to 7.5 is a stretch. I think India will get there. The trends are there. But we do really need to say how we prime the economy to do better going forward. And that will have to come from encouraging investment and from giving a good hard look and push to exports, more so because of global headwinds and some of the factors you mentioned on oil prices going up, because our current account deficit, looking very strong thus far, begins to feel the pressure of a higher import bill. So we do need to get our exports going again.
Yeah, just on the issue of exports, and Mr. Arun Kumar, if I could come to you with that, because through the survey there is a lot of, consideration on reviving export growth. And I want to pick up in particular what the survey says in terms of manufacturing. While the manufacturing share of GDP has improved slightly, there has been a decline in manufacturing export to GDP. Of course, it talks about the real effective exchange rate, which has appreciated about 21% since 2014. But it asks the question, do export incentives work? And it gives the example of the 6,000 crore rupee textile package to suggest that yes, they do. Now, the Commerce Minister has also been batting for export incentives in this budget. My last conversation with him, again, he reiterated that these shouldn't be seen as subsidies, but these should be seen as productive incentives for growth. Given what we've seen in the survey, what would your expectation be from the budget when it comes to the export-led sector?
Well, it's difficult for me to hazard what the budget would say, but what I would say is that this was a very positive fact brought out by the survey, that there has been an increase in exports, and that's partly fueled by the global uptick in economic conditions. The other part that I noticed was that the states that export internationally and interstate are particular beneficiaries in terms of employment and economic growth. And the ones that are exporting internationally are doing even better than the ones that do interstate. So I thought the lesson from that is that it's important to focus on increasing exports. States should get engaged in increasing exports. And you can see that 4 or 5 states actually undertake most of the exports. The second aspect is that most of the export increases came from MSMEs, which are actually the big employment generators in the economy. So the more exports can rise, the more employment will be created. With regard to your question on manufacturing, it's a difficult question, but it seems to me that the GST, which will make logistics easier in the country, and the increasing investment in infrastructure will both contribute to more competitive supply chains and more competitive manufacturing.
Well, that point is taken. Now, before I get to the specific export argument, because there's a very strong argument over there about how interest rates are impacting exports, I won't get into that immediately. But Jahangir, you know, the CEA has made, okay, we'll get Jahangir in a minute. Let me put this to Shaumya Kanti Ghosh. Shaumya, the CEA has made a very strong argument on why India did not participate in the global growth. 2017 was a period of synchronous global growth of, you know, Europe, Japan, and of course the United States, but India didn't participate. And he blames this on, one, high real rates, you know, not in keeping with the way global rates were falling in late 2016. He blames it on, of course, GST and demo-related disruption. And finally, on the twin balance sheet. He says now all this is behind us and we should be able to grow with the world. Do you buy this? Do you think all this disruption is over and now we will fully be able to participate with the synchronous global growth?
To some extent, Lata, I should agree with this point because if I look into the disruptions and if I look into the latest numbers, I mean, if you look into even the credit growth numbers which are coming out in the last 2 months, that looks quite impressive, even if I look into all the statistical artifacts. So I think that the green shoots are finally beginning to play out more positively. And the other thing which I would like to mention out, in fact, the historical trend suggests that in those golden years of 2005 and 7, when India is witnessing 9% growth rate, and global exports, the way they are moving right now, whenever the global exports go up, Indian exports also go up, but with a multiple of that amount. So basically, I think now the time has come. We had a 12% export growth rate last time, but we were 30% before that. And I think the last 3 months of the year are always good enough in terms of an export growth. Hopefully, if the global export continues like this, which is likely to be in the this calendar year, I think Indian export could stage a strong revival, and that actually could be the starting point of a better growth numbers going forward. Okay. Oh, yeah. Would you agree with that, Mr. Arun Kumar? You think Indian exports look poised to recover?
Well, I think the global economy seems to look very good. Shireen and I...
The global recovery is 12 months old, and our exports have not chimed in. Only in the last 3 months, we have shown the 3-month average has now risen to about 12.5% export growth. So, I mean, are the companies you interact with telling you that they are over and done with the disruption in supply chains and now they can participate?
Yeah, the companies we work with certainly see that the disruptions caused by a couple of events last year are behind. They also see that they're now focusing on growing. So that's a general trend that we see. Certainly companies here, we see them focusing more and more on growth. In the past, there were issues of overcapacity. People feel that overcapacity is coming down. We also see that the commodity cycle is picking up in a favorable way. So there are many reasons that are going to drive growth. So I think that growth will also come with driving exports and a focus on exports.
Okay, Shireen?
It will have to be driven by growth in exports. But let me go across to Geoff Lewis. And Geoff, I think one of the cautionary statements coming in from the chief economic advisor also had to do with the rally that we've seen in the Indian stock markets. And he says that the Indian stock market surge is different from that in advanced economies in 3 ways: growth momentum, level and share of profits, and critically, the level of real interest rates. By that token, India's valuation should be much lower. So he's saying that if growth doesn't pick up, then we could be beset with the possibility of a correction in the Indian stock markets. How would you read what the Chief Economic Advisor has said with respect to the difference in valuation and growth expectations to do with the markets?
Well, I think that's right. I think if you look at the earnings expectations built into the market, the consensus is for very strong growth. There's been some disappointment. It's been late in coming, but it now looks as if the disruptions to the real economy, that's water under the bridge. So we are looking for a pickup also in India's GDP growth over the next 12, 18 months. I think if it doesn't come, then quite likely the Indian stock market would suffer a significant correction.
Okay, so but what's your own sense, given what we've seen on the earnings calendar so far? Have you been given more reason for disappointment, or have you been given more reason for cheer?
I think it's early days. I think we're still not convinced, so we're looking for an inflection point. We think it will come through. So I think a lot of foreign investors are in a similar position. So, well, we are looking for India to deliver in terms of earnings and profits growth as the economy recovers through 2018.
So, Geoff, before we take a break, let me ask you, as a foreign investor, what are you going to be watching out for when the Finance Minister presents the budget on the 1st?
Well, continuity of policies, market-friendly policies, continuation with financial reform, with reducing NPLs, commitments to privatization, basically continuation of the policy agenda of the Moody government. I think they're doing a pretty good job at the moment. And I think that now some of these short-term hiccups are through. Looking at GST, I think the full efficiency benefits are something you'll only find over the medium term, but it certainly sounds as if we're getting off to a good start.
All right. The survey does highlight the fact that the government should focus on things like the 4 R's, privatization, staving off the macro threats. We'll get you more on that as we continue this conversation here on CNBC TV18. We're decoding the economic survey presented by Chief Economic Advisor Arvind Subramanian. Back in a moment.